when life insurance is a terrible idea. In this video, I'm going to break down when you should not use life insurance. So I keep having this same call over and over again. I'm so grateful to everybody who watches this channel, but here's a call I keep getting over and over and over again. Somebody is in their mid 50s. They tell me they want to retire around age 65 or 70, and they met a life insurance agent who said, okay, you know what? You don't have any other income other than Social Security. I'm going to sell you a life insurance policy that you can put a lot of your money into before you retire, and that will be your second source of income. To me, this is a huge mistake. Now, I want to be clear. I can't determine if it's a mistake if I haven't met you, determine your situation, really gotten to know you and understand if insurance is the appropriate next step. But I can tell you oftentimes that this is going to be a misstep when you're seeking out how to position your retirement income. And the reason why is too many people are relying on over-illustrated life insurance policies to provide them a steady, secure stream of income in order to retire. Now, on its surface, you might think, okay, well, Daniel, what's really wrong with life insurance? A lot of times, depending on the policy, it's going to be a place where you can create some safety on those dollars. You can potentially have those dollars grow inside the policy. You might even be able to set up the policy so that you can use it and distribute loans that can come out tax-free. And based on a lot of these illustrations, you might be able to show yourself a way where you can get far more income than where you could go for any other type of strategy in order to derive that same level of income. So on the surface, it sounds like a good idea. And because the illustrations can be set up in a way that make them look very enticing, this often does seem like a good idea. And you have an agent who's supposed to be a retirement expert saying, hey, this is what I would do with my dollars, or this is what I am doing with my dollars. The problem with it is life insurance can provide income. The tricky thing is just because it can provide income doesn't mean that it's going to provide income at the level that it's being illustrated. A lot of people get married to these illustrations. So let me give you a good example. Somebody's going to retire and they have maybe a decade to get ready. And the illustration says, okay, if you can just commit $1,000 a month to this policy and it earns 6% for the rest of the policy's life, you'll be able to pull out somewhere in the neighborhood of $1,000 a month for retirement income through the form of tax-free loans. These illustrations are floating around everywhere. I've seen them a million times. And so somebody's like, oh my gosh, that makes total sense to me. I'm going to put $1,000 in a month. I'm going to be able to keep the money safe in my policy, and then I'm going to be able to take tax-free loans for the rest of my life, and all I need to do is earn 6%. It seems like, well, why wouldn't that happen, right? If it's an IUL and it's based on the index, you say, okay, well, the S&P 500 makes more than 6, so I should be good. That all makes sense, right? That seems like a good idea in order to be able to prepare for retirement income. The problem is that these IULs rarely live up to their illustrations expectations. And everyone knows that you don't just get a steady 6% every single year. Some years will get more, some years will get less. And so the illustration is basically worthless because it's not assuming a Monte Carlo simulation, which is you can plug in different variables like rates of return or losses. In this scenario, it's like basically illustrating a CD at the bank. Like you're going to get 6% every year you own it. Well, if that happened, then yes, it is possible. But there's other things that are outside of your control or that may be within your control that you don't realize have an impact on the outputs of those loans. For example, when you pay your premium, it has a big impact on if that illustration will actually hold up and you don't pay it on the exact day that you're supposed to pay it every single year. The company could change the fees inside the policy, and that will have a drastic impact on your policy. The type of loan you select and the order of the returns from the underlying index. Now, the same thing goes for whole life. There can be things that change. Now, it's not the same as an IUL. There's different metrics that can change, right? There's a dividend and there's other things that could impact the cost down the road. But again, at the end of the day, what's important to realize is I don't think life insurance is the right vehicle in that situation. You could use an annuity, which is going to basically just provide you a stream of income that you can set up, and the company will provide you with a guaranteed illustration saying, hey, regardless of how it performs, this is what you can count on. Now, you can get a guaranteed illustration for IUL, whole life, other types of insurance, but oftentimes if you look at that guarantee, you're not going to get nearly the same income, and most of the time those policies will actually collapse under the guarantee if you're setting it up like I mentioned in the example before. Whereas the annuities guaranteed column on the illustration has actually a very reliable and predictable source of income. That's because an annuity's primary role is to create a lifetime income stream. That's why people purchase those. Now, again, I'm not saying that the annuity is the right fit in that circumstance either. I'm just saying that's an example of something that's actually designed for income. The real risks that you have with life insurance when you're putting that much pressure on the policy, which again, a decade to save in a whole life insurance or IUL policy to then get a lifetime income is a very short amount of time. That puts a tremendous amount of pressure on the policy in those first 10 years and even more pressure on the policy when you go into the distribution phase where you're taking those loans or withdrawals. That policy really has to perform and the pressure grows every single year. You have one misstep in that policy and you could see that thing collapse. And what I mean by collapse, and people are often shocked when they look at their illustration and say, well, what does lapse mean? Like, what happens? And I tell them, well, lapse means the policy goes away. And they go, what do you mean it goes away? Like the death benefit, but I still get, it's like, no, the whole thing goes away. All the money you put in will go away. That's the risk of misusing life insurance. And so this is where I get really concerned, is because if you have somebody who's really counting on this policy and they had 10 years to save and they save thinking, oh, I'm good, I got this life insurance policy. The illustration shows that the loans are going to couple with my Social Security. I'm going to be set for retirement income. That's what I need to live on. And then they come to find out that maybe 4 or 5 years into taking the loans, their policy's on track to collapse in a couple more years or maybe even 10 more years. That is devastating. That can actually be something that would be horribly tragic for somebody who is saving and they had the intention of doing it wisely based on what someone else recommended, but really it could be very, very tragic. If you're in a circumstance where you're very close to your retirement, and I would argue that in this example, close would be 15 years or less, and somebody's showing you life insurance as the primary method of saving to get the rest of your retirement income you need after Social Security, I would strongly caution you to take a second look at that. Now, again, that's not a recommendation. It's just you want to be cautious of what you're purchasing. Life insurance has a lot of great benefits like the death benefit or living benefits. And you know what? I have a life insurance policy and I think that has all kinds of utility that you can use the cash value for. However, I would not use it in that circumstance. It's too risky and it puts too much pressure on the policy, and the potential outcomes could be devastating for that retiree. So again, take a second look at this policy. If you need a second pair of eyes, I can review it for you. My team can review it for you. But take a look early, because the earlier you catch these things, oftentimes potentially the more future risk you can avoid. And again, that risk can absolutely be devastating for your retirement if you're too far down the line. If you were 65 years old and all of a sudden like, okay, it's distribution time, and you come to find out it's not going to work out the way you thought, there's no more time to save. So the risk is too high. Get a second opinion on your policy. Take a look at it. Make sure it's on track to do what you need it to do in order to make sure you're not going to take a huge misstep for your retirement. Again, I don't want this video to be negative. I think this is hopefully designed to be optimistic and to give you the right piece of information that you need to make the right decisions about, is life insurance right in this stage of life or not? Again, if you're saving for retirement and you have somebody relying on your income and you need protection, a term policy is different, right? This isn't a policy that's designed to put money into to take income out. This is a policy that's just designed to protect your life, to remove financial risk in case you're not there to earn income. That could be a great use of life insurance in that phase to protect you as you finish your retirement savings. So again, if you like this video and you want more information on this, please watch this video right here about different types of life insurance and when you can use them appropriately.